Welcome to RCLCO's May macroeconomic update. I'm Scott Bommarito, and today I'll review a few of the latest developments in the US economy. The April CPI report showed some promising signs of moderation in inflation. Over 2 months of acceleration, headline CPI slowed 10 basis points to 3.4% in April. Core inflation also cooled and fell to its lowest rate since April of 2021, but it remains above headline inflation at 3.6%. Month over month, both indices rose about 0.3%, which is a smaller increase than in March or in February. Despite this April slowdown, inflation has accelerated over the last 3 months. The all items index rose 4.6% on an annualized basis, and the core index was up 4.1%, causing the Fed to delay its planned interest rate cuts. Both overall and core CPI remain notably above the Federal Reserve's 2% target. Economists expect that inflation will continue to slow gradually and return to the Fed's target sometime around mid-2025. However, as the last few months have shown us, it may not be a smooth path back to 2% inflation. Job growth also cooled in April as the labor market added 175,000 new jobs, roughly in line with the long-term pre-pandemic monthly average. This represents a notable slowdown from the last 4 months, which posted very strong employment growth. As job growth has slowed, the unemployment rate ticked up 10 basis points, but remained low at 3.9%. It has hovered at or below 4% since late 2021, indicating just how tight the labor market has been over the last few years. The labor force participation rate held steady at a little below 63%. It has still never fully recovered to its pre-pandemic rate. However, some other measures of labor force participation, for example, the prime age employment rate, have surpassed their pre-pandemic levels. Interest rate forecasts have been volatile so far in 2024. At the start of the year, markets and economists predicted that the Federal Reserve would begin cutting interest rates fairly quickly. Persistent tightness in the labor market and a resurgence of inflation quelled those expectations. Pricing in interest rate futures markets now implies 2 or possibly only 1 rate cut for the year, with the first cut coming in September and a second cut possible in December. US Treasury yields are also elevated, and the yield curve remains inverted. 3-month Treasury yields have held steady near 5.5%, while 2- and 10-year yields have been somewhat more volatile. Both have fallen modestly over the last month, but remain up over the last year. Recently, recession fears have faded somewhat, giving way to fears of an inflation resurgence, but a recession certainly remains a possibility. One possible signal of this risk can be seen in purchasing managers' indices, or PMIs. The Institute for Supply Management's PMI showed a contraction in April. Services PMI fell into contraction after 15 consecutive months of expansion. Business activity and employment both declined month over month, dragging down the overall services index. Manufacturing PMI also registered contraction after a brief recovery into expansion last month. Production and new orders both fell. Employment increased month over month, but it remained the lowest component of the manufacturing index. The Federal Reserve has indicated that it will move slowly and remain data dependent as it considers when to cut interest rates and by how much. So far, the economy has largely weathered the new high interest rate environment, but downside risks certainly remain. That concludes our May economic update. Follow RCLCO on social media for more insights, and don't forget to tune in to future webinars.